Why doesn't your financial fiduciary provide you with after-tax IRA, 401k annual statements? You ever wondered? You know, as a financial strategist and retirement planning specialist now for 5 decades, I have met with thousands of people at retirement, because at retirement planning is something totally different than maybe what you did for retirement. Most people for retirement put money in tax-deferred IRAs or 401ks, and I'll prove in this episode why I feel like they're being duped, okay? But for their first appointment, I would always ask them to bring their after-tax IRA, 401k statements to the appointment. I knew they didn't have them, but it would make them think, after tax? I go, okay, I'll calculate that for you. They would be flabbergasted because they might have $1 million in their IRAs or 401ks, and I would have to disclose that's not all your money. Only about $650,000 of that is yours. The other third belongs to the government. And they just thought, oh my heavens, I thought I was going to be in a lower tax bracket. So get ready. I'm going to show you what you can do that is far, far better, and why most financial advisors never talk about the after-tax effect of your IRAs and 401ks. So I've been a financial strategist and retirement planning specialist for 5 decades, and I've been helping thousands of Americans optimize their assets and minimize taxes and prepare for a comfortable retirement so they will not outlive their money. And so most people come maybe 5 years before retirement, and they start waking up and realize that maybe what they did for their retirement, putting money in traditional IRAs or 401ks, deferring to some future perceived unknown advantage, being told, oh, you'll likely be in a lower tax bracket. And now that they've saved a bunch of money, they're not in a lower tax bracket. I'll explain why. And so at retirement planning is something totally different than maybe what you did for your retirement. And I always ask them, well, listen, bring your after-tax IRA, 401k statements to the first appointment. I knew they didn't have them, but I wanted them to think. I said, well, I'll calculate that for you. And they would always be shocked when I would show them that about a third of whatever they had accumulated did not belong to them. Their partner was Uncle Sam, okay? Now, they usually don't like that partnership when I begin to explain it to them, but let's just address in this episode, why doesn't your financial fiduciary, who's supposed to be looking out for your best interest, by the way, when they saw that you were a saver and that you were likely headed towards a retirement where you were not going to be in a lower tax bracket, and yet they continued to let you defer, postpone, procrastinate paying tax to some future perceived unknown advantage, and then withdraw your money down the road when they could tell you were going to likely be in a lower, a higher bracket. What? Were they really looking out for your best interest? I don't think so. So, see, a lot of people don't realize when you're going down the highway of life, trying to achieve this destination of financial independence, so many Americans are duped because they've got one foot on the gas pedal, but the other foot's on the brake pedal. The other one foot on the gas pedal would be a tax-deferred IRA or 401k, accumulating tax-deferred. But the other foot's on the brake pedal. They're actually killing the tax deductions before they retire. Most people are paying off their house and their real estate, and so they lose those deductions. In retirement, you're not contributing money to IRAs or 401k, so you don't have those deductions. The kids are gone, or if they move back in as adults, you can't deduct them anymore. If you were a business owner and you sold your business, you don't have those deductions anymore. And because of irresponsible government spending and the printing of money, most Americans who are savers are not in a lower bracket. They're in a higher bracket because the government keeps spending more money and raising taxes, okay? If I ask audiences when I speak throughout the country, how many of you think that taxes in the future will likely be lower? I get nothing but crickets. I say, how many of you think they're going to be the same? I asked that of an audience the other day. There were 300 on 2. 2 out of 300 said, we think they're going to be the same. The vast majority all think they're going to be higher. And then I ask, well, then why are you continuing to postpone, defer, procrastinate? When has procrastination ever turned out good for you, by the way? Paying tax to some future perceived unknown advantage and then withdraw your money later when you're convinced taxes are going to be higher. And all of a sudden I realize this is stupid. But they didn't realize. And so why is it advisors do this? Well, they're following the herd, okay? So let's go through and show you that money in a traditional tax-deferred IRA or 401k, it is growing tax-deferred, but your partner is Uncle Sam. They have a permanent tax lien on that. They get a third of whatever that's going to grow to. So their portion will continue to grow. They're using you as their savings bond. It's the best savings bond they ever came up with for themselves. They're simply piggybacking on your savings, okay? And so deferred taxes really means increased taxes, and I can prove that to you mathematically, especially if you're a disciplined saver. I would prefer to accumulate my money totally without tax-free, and that is accomplished under 3 sections of the Internal Revenue Code, 72E, 7702, and 101A, which when you are in compliance with those under 3 tax citations, TEFRA, DEFRA, and TAMRA, with a max-funded, a property-structured, maximum-funded IUL, Index Universal Life, you can accumulate your money totally income tax-free at net internal rates of return within 1% of the gross rate of return. That 1% difference is not tax. It is the cost of the insurance that the IRS says has to be there in order for it to be tax-free, but it's not a cost. It's actually a benefit. It will help your account to blossom and transfer tax-free when you ultimately pass away. It's money that would otherwise go out the window in unnecessary tax if I put my money in IRAs or 401ks like most of Americans, okay? Let me just cut to the chase. In an IUL, I can earn 11 and net 10, cash on cash. In an IRA or 401k, to net 10 after tax, I'd have to earn 15. After tax and fees, I'd have to earn 16% with an asset manager to net 10 after taxes and fees. I only have to earn 11 in net 10, and I can do that more safely and predictably with IUL than to be at risk with my money in the market trying to average 15 or 16%. To try to average that, you're taking unnecessary risks, okay? Now, in order to understand this more fully, let me use the 4 phases of retirement planning. So when you're socking away money for your future goals, such as retirement, we have the contribution phase where you're contributing money. That usually overlaps the accumulation with hopefully the growth, interest, dividends, or whatever you're earning. And then someday you're going to start taking distributions out of that, withdrawals. And too many people go into withdrawal during this phase because the amount of tax they pay. And then none of us are getting out of here alive. I don't mean out of this little video here. I mean out of this life. We usually leave behind something that would have sustained us had we lived longer. And so that's the transfer phase. So let's look at these 4 phases, and I'm going to go through 5 general categories of savings alternatives, okay? And I'm going to go from the worst to the best. Now, the first, which is the worst, is the most common way people save in America, taxed as earned investments, okay? These are banks, credit unions, regular mutual funds. You're taking after-tax dollars. You go out and earn money. You pay your annual income tax. You take the after-tax money and you put it into a bank or credit union. And then every year they send you an interest statement with the interest they credited you, the dividends. And so you have to pay tax every year. On any gains, you pay tax. And when you die, the person you leave it to has to pay tax on those too. Tax, 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 tax. Let's compare this to like a race. And we're going to call this the $1 million dash. So we're trying to race around this racetrack to end up with $1 million net after taxes and fees. This would be like crawling around the racetrack, as I'm going to show you mathematically in just a second. Now, some Americans think they're pretty clever because they take after-tax dollars and they put it into a tax-deferred annuity, okay? After tax, into a deferred annuity, it grows tax-deferred. But if you put in 500 grand into an annuity and you immediately annuitize it, and let's say you had a 10% payout, just to keep it simple, you start pulling out 50 grand a year, and that's all taxable. Because the last money you're earning is the first money coming out. That's called LIFO tax treatment. Most investments are taxed LIFO. So you have to pay tax on it when you take the money out. So there's only one green circle in that one. That's like walking around this racetrack. Let me show you mathematically what I'm talking about. If you have $1 and it doubles 20 times, so for 20 periods, $1 doubles to $2, $4, $8, $16, $32. $1 will be worth $1,048,000. That's compound interest. It's like a miracle, okay? Now, that's only if it's tax advantaged, because if you save the way most Americans do, and that dollar doubles to $2 in a bank or credit union or a mutual fund, and you're in a 25% tax bracket, you have to pay 25 cents in tax. You only have $1.75 left. That $1.75 doubles the next year to $3.50. Now you pay tax of 25% on that. So you have $306. You'll only have $72,000 instead of $1 million. Only 7.2% of what you could have had. Well, a lot of Americans are in 33% tax brackets between federal and state tax. You would only have $27,000 instead of $1 million. 2.7% of what you could have had. This is the way most Americans save. That's why they don't have anything. Now, let me use a metaphor I've used for years. If you were a farmer and you had the choice of buying your seed in the springtime that you're going to plant, and you don't have to pay tax on what you pay for that seed. And you plant it, you irrigate, you cultivate, you work hard, and then in the fall, you harvest your crops. And now you agree to pay tax on what you sell your harvest for, okay? That's a traditional IRA or 401k. You get a tax break on the seed money, but you agree to pay tax when you harvest your money in retirement. That does not work if you think your taxes are going to be higher in the future. I would rather pay tax on the seed and enjoy the harvest without tax, okay? So if you look at a traditional IRA or 401k, you get a tax break on the seed money, and it accumulates tax deferred, but when you go to access the money during your harvest, it's now taxable, and it's taxable during the transfer. You only get 2 green circles. Now, mathematically, I can show you that a Roth IRA or 401k, if you think taxes are going up, a Roth will provide 50% more income, but I've never owned an IRA or 401k, never will, and I've never owned a Roth IRA or 401k, never will, because on other episodes on this channel, I explain my favorite vehicle, a max-funded IUL, knocks the socks off of a Roth. Roths only have two benefits. Max-funded IUL, a laser fund, has those 2 benefits and has had them way longer than Roths have been around, plus 4 additional benefits that Roths will never have. So why would I mess around with all the strings attached and restrictions and limits on how much I can put into a Roth? Or if I make too much money, I can't even have a Roth. Who wants all those restrictions, okay? And so that's why I don't do that. I put my money into an MFTA, max-funded, tax-advantaged, Section 101A alternative. In a nutshell, I fund it with after-tax dollars. My money accumulates tax-free under Section 72E of the code. I can access that money tax-free. Every million can generate $100,000 a year of tax-free income. From age 65, if I live to be at 120, without depleting principal, if I rebalance, come in for annual reviews, and we teach you how to do that on my channel, okay? And then when I ultimately pass away, anything I leave behind transfers income tax-free, and it usually increases in value. It blossoms, meaning that if I died tomorrow, I'm 72, okay? If I died tomorrow, every million I might have in an MFTA laser fund would double to about 2 million and transfer tax-free. People say, well, how much does that cost? Well, nothing's free, but it doesn't cost me anything. It's being paid for with a minuscule portion of money that would otherwise go out the window in taxes if I did this strategy right here, just a 2 green circle strategy, okay? Now, I like to have my cake and eat it too, and so in my various books and on my YouTube channel, I show people how you can actually resurrect deductions that maybe you were killing on your rental income real estate, for example. How you can use 100% tax advantage dollars on the front end, but never in trade for taxable harvest, okay? And so I like to have my cake and eat it too. In a nutshell, 4 green circles will give me usually triple to quadruple what an IRA or 401k generates. But even if I don't get 4 green circles, if I get 3 green circles, it's 50 to 100% more, sometimes quadruple, depending upon the situation. We have several episodes on this channel that show you illustrations of MFTA, the 3 green circle strategy or the 4 green circle strategy. But it blows the 2 green circle or 1 or none out of the water, okay? So if you want to see how this works mathematically, let's go back to that chart. Sometimes people say, okay, I understand tax as earned is not good. I don't want to have 2.7% of $1 million. I want $1 million. But Doug, I have my money in an IRA or 401k. It's worth $1,048,000. You have $1,048,000 in your IUL laser fund. What's the diff? The difference is this. You don't choose investments based upon which ones grow to the most. You choose them based upon which ones generate the most. At the time in life, you're going to be using or needing the money the most, retirement. This is the front 9 of an 18-hole golf game of life. Let's go to the back 9, okay? So let's say I need to start generating income. Now, if you put your money in tax as earned investments, you're going to be out of money the first year of retirement if you need $100,000 a year to buy gas and groceries, prescriptions, and golf green fees. Now, if you have $1,048,000 in yet to be taxed IRAs or 401ks, and let's say it's earning 10%, I'm going to use 10% because it's easy math, and I've actually averaged 10.07 on my IUL now for over 30 years. So if I want to pull out $100,000 out of my $1 million nest egg in an IRA or 401k, if I pull out $100,000, I'm only netting maybe $650,000 or $700,000 after tax. What if I need $100,000 net? How much more money do you need to withdraw in a 33% tax bracket to net $100,000? You need 50% more. You have to withdraw 50% more in a 33% bracket. I need to pull out $150,000, pay tax of a third, 33%, 50 to net 100. If I did that, my $1 million nest egg in an IRA or 401k will be out of money in 11 years. By age 76, I'm living off of Social Security, welfare, charity, or children for support. If I have the same amount, $1 million in an IUL laser fund, I pull out $100,000, I net $100,000. It's tax-free. I still have my $1 million when an IRA or 401k is out of money. A baby boomer couple, one of you will probably make it to age 96. That's another 20 years. I could have another 20 years of $100,000. That's $2 million. Plus, I still have the $1 million in there. That's a $3 million better retirement strategy than the same amount of money at the same age, 65, in an IRA or 401k. It's that cut and dried. How many of you would like to have a $3 million better retirement strategy than an IRA or 401k? So that's what I can help you do. I want you to achieve 4 green circles. So I flipped them here because this is poor, this is fair, this is good, this is better, and this is best. So I want you to have the best way to save. If this is resonating with you, I would encourage that you reach out, that you learn. You can claim a free copy of my book, The Laser Fund, if you buy one on Amazon for $20 to $60. Thank you, but I'll give you a copy free. You simply claim your free copy of this 300-page book by clicking on the link below or going to laserfund.com. You contribute a nominal amount towards the shipping and handling. I require a little bit of skin in the game. I'll cover the rest of that, and I'll pay for the book. I will fire out a hard copy to you via priority mail. Now, when you're in there claiming your free copy, if you'd like to listen and learn or watch and learn, there's additional resources there you can invest in. If you want to attend a free educational webinar, we teach them every week. There's no charge. If you want to talk to an IUL specialist with no cost or obligation, you can even schedule an appointment to see how a properly structured max-funded IUL can benefit you in your particular set of circumstances and get your money out of those IRAs or 401ks, and you'll understand why your fiduciary does not want to show you the after-tax IRA 401k statement because you're not going to be happy. I want you to be happy and not outlive your money.